One. All right, hello everyone. Welcome back to another video. This time we'll be talking about the difference between a stock, an option, and a bond. Which usually, when people say bond, they might actually just mean fixed income. So let's get into that and talk about what that is. So first of all, what are these? They're called asset classes. So there's other asset classes out there. These three are the most common, with options being kind of least common. They all have their uses. You don't need any of them to create a great portfolio. You can also just have funds, which we'll get into a little bit later. And a lot of them, each one of them have a different risk and return profile, especially the options, who have a lot of inputs into them to actually get it correctly if you have a strategy. Okay, so let's just dive right into it. I know a lot of you, when you think markets, you think stocks and bonds. That's kind of what you see in movies, and what other people talk about stocks and bonds market, right? If you even the book Intelligent Investor, or that everyone kind of raving about, only talks about the difference between having X amount of stocks in your portfolio or percentage and X amount of bonds in your portfolio. So let's start off with stock, because that's kind of the most common thing. Buying stock in a company, if you're saying you're buying equity in the company or shares in a company, means exactly that. So what you're doing is you're going into the public market and you are purchasing ownership of that company. So however small, right? Because most of us won't be able to afford millions and millions of dollars to actually own like 1-2% of these big companies. So what actually happens is it's your ownership right. So common shareholders, if you're trading on something like WebBroker or the other brokerages out there, usually you're buying common shares. There are also preferred shares, which the word preferred just means in case if they go bankrupt, they give you the money first, because preferred shares act kind of like debt and equity. Whereas common shares are just equity, right? So what is actually equity? You're owning ownership. You have an ownership of that company, however small, and no one's guaranteeing that you're going to make money or lose money. Whereas in a preferred, they're kind of guaranteeing a little bit of a return, but they don't know if it's going to go up and down, right? So that's kind of the difference, and we'll talk more about debt instruments in the next slide, which are also bonds or fixed income, as we call them. Okay. Now, the way that you actually make money off shares are capital gains and dividends. Okay, so have you ever asked yourself, why do the price actually oscillate? Why do they go up and down? Like, is that the company doing that, or what? So what's going on is we're actually in the secondary market when we're trading. Usually, most of us, we're in the secondary market, which means that after a company has gone public and they've done their IPO, initial public offering, and they sold it to their underwriters for 50 cents on the dollar, whatever they paid for it. It then goes into the secondary market, and that's where people buy and sell from each other, not from the company itself. They can do a buyback, but most of the time you're buying and selling from each other. So really, when a stock's going up, it just means that people, so all of a sudden, love this company. Maybe it was on the news, and they're like, great, I need to buy, right? So they go in and they start buying, and obviously the more people that want to buy, if there's kind of that discrepancy, less people selling, more people buying, it's going to go up, right? So that's your capital gains. Now remember, in terms of the other way around, you can also have capital losses. So if you're watching this, you also need to think about which account you're putting it in. So a registered account, such as a TFSA or an RSP, they don't count capital losses, right? But they also usually don't tax you on the capital gains, or they tax you much later on the capital gains. So usually you want to do the less risky stocks there, right? Now there's also dividends. So what actually are dividends? This is direct from the company. The company, they might have extra cash flow, or they just want you to incentivize you to hold their shares, so that they seem like a prosperous company. They actually pay you monthly, quarterly, some biannually, or maybe once a year, but most of the time quarterly and monthly. They'll pay you a percentage of how many shares you own, and they'll give you a cash flow of what they have. Obviously, the more shares you have, the more dividends you're going to make, right? So a lot of people, this is their strategy. If they have millions and millions of dollars, they put in a very safe stock that they know is not going to go too crazy, but it has a 3-4% dividend, and then your 4% of 10 million is a nice amount to live on yearly. If you have a more kind of like medium lifestyle, let's call it. So another names for stock is shares, equity, and securities. Okay, so now the segue from preferred over to the next slide is pretty nice. As you can see, I bond on this picture, they're bonding their hands. Anyway, when people say bonds, they usually mean fixed income or debt instruments. Okay, so first of all, let's talk about that difference. So I told you guys that equity is when you own ownership in the company. Debt is when you're in debt to someone. You guys know about credit card debt and student loans and all that stuff. It's not like, they just say, oh, wow, we'll just give you this money and you make it or not, and then you pay them crazy returns. No, you have a fixed amount, percentage of what the loan is, and that's how much you have to give back your principal, so the amount you owe plus the interest, right? So whatever it was, 34, 5, 10%. Okay, obviously keep it as low as possible. But when you're lending your money out, you want to make as much as possible, right? So what is a bond? You're lending your money out. What is a fixed income? You're lending your money out. So that's why it's fixed. They give you a fixed percentage. So these bonds can be corporate bonds, government bonds, GICs. Government bonds, if you've received it from your grandparents or you bought them yourselves, they're usually very safe because they're backed by the government. And if the government is something like Canada or US, there's a very low sovereign risk. What is sovereign risk? Sovereign risk is the probability that a country will go bankrupt and not be able to owe you money. So that is very unlikely for the government Canada, government United States to default on that. So that's why they pay you a low percentage, because what you're paying for is the safety, right? And there's also corporate bonds. So big companies, TD, BMO, and all that. If they're backed by their wealth management space, they'll give you a higher percentage than the government because they're not as safe as that, but still won't be too high. But if you see something like, Wally's inflatable emporium franchise or whatever, those are usually what we call the high yield bonds or junk bonds, where you might actually lose your money. So if they want to borrow from you, they want to pay you something that's going to make it attractive for you to take that risk of possibility of losing your money. So high risk and high reward there. There's also GICs, which are the bank issued, not to be confused with the actual corporate bank issued kind of guaranteed investment certificates. I haven't had to say that acronym for a while. And they pay you, basically you're lending money to them, and they pay you a higher percentage based on how many years that you're locking it up. Something between 1 and 5 years are usually the norm. But in this environment, of course, it's going to be lower, right? So what do they actually do with that? Well, you're loaning them the money, so they're taking that money and they're investing it in other things that are making it a higher percentage, and that's how they make money. The spread, right? The spread between what you're borrowing and what you're lending, or what you're borrowing and what you're investing into the equity. Okay. Finally, we have options. So these are ones that are a little bit more complicated, and I'm not actually going to go into the actual strategies of options or specifically what they are, how to trade them. I'm just going to give you guys an overview and their kind of definition. So if you guys take a look at this picture, it's not just for show. This picture defines basically what options are, because you have the bull and a bear. Okay, so if you guys have heard the terms, you guys heard of that. Most notably, they're on Wall Street, right outside. Bullish position is one where you're hoping, betting, thinking that it's going to go up or at least stay above neutral, right? Bearish one is you're hoping that it's going to go down, slightly down, all the way down, or just below neutral, depending on your strategy. Okay, so and when we talk in terms of these, you have two separate. You have options, but you have two separate positions. You have puts and calls, and you can buy or sell a put, buy or sell a call, buy or sell a put. Okay. So we won't get too much into that. I'm just going to kind of explain basically what they are. So you guys can imagine let's say a horse track. Okay, so let's say that. So I'll give you guys this statement. The option how you're actually making money is you're betting on the direction. If you're gambling, you're betting on the direction that the stock is going. So let's go back to the horse track. If you own stock, let's say that you are carrying and breeding horses and you're entering them into the competition, right? Competition has a prize pool, and if your horse wins, you make money. So capital gains, right? You own the horse, you fed the horse, maybe you bought the horse, trained it, right? You've cared for the horse. You're very much emotionally and financially invested in this. Now, people go to the horse tracks, they bet. Do they own the horse? No, not necessarily. Do they feed the horse? Have they even touched the horse? Have they even been near the horse? Most likely not. People are just going there to bet, right? So when they're betting, if they're bullish, they're betting that the horse will win or top 3 or whatever, right? If you're betting on the horse winning, you're usually taking a higher risk, higher reward. If you're betting that, the horse, I don't know if they do this, but let's say it gets in the top 3 or the top 5, you're going to get less reward for that because obviously people on the other side of the bet aren't going to bet against top 5, top 10. If there's only like 12 of them, right? They're most likely going to lose. So if you're bearish, I don't know if they do this again, but you're betting that one of the horses loses or in the bottom 5 or something like that. Okay, so that's kind of the way that options work. So you have a higher risk, higher reward, but you're not invested into the actual stock itself, right? So what that means is you can make a lot with a lot less money, but you can also lose a lot less money. Okay? Options also are a zero-sum game. So what does that mean? In a stock, if you buy it at 50, sell it at 55, someone buys it from you at 55 and sells it at 60, you made money, the other person made money, exactly $5 per share. In options, one person loses, one person wins. The way that you are losing is someone is winning your money. The way that you are winning is other people you are taking, obviously not legally, you are taking their money, right? They bet against you. You guys put it into a prize pool, and at the end of the day, you grab the prize pool and they leave home with hopefully nothing. Sometimes they could leave home owing, right? So anyway, that's kind of getting too out there. If you guys do want to learn more about options, the different strategies that there are, I don't know all of them, but some of them, and how actually they work and how to actually trade them, please leave me a comment below. I do need to make a whole other video for that. Okay. So to conclude, which one? So you can have none, 1, 2, or all 3 to have a successful portfolio. If you guys just are out there YouTubing and Googling what's a stock, what's an option, or anything like that, and you haven't really gotten started, I don't recommend getting into options right away unless you have a really great mentor that's going to sit with you, or a financial advisor that explain that for you and show you, and they have a good track record. I don't even recommend getting way too into the shares yet. You could actually look at funds. The pros and cons of that is someone manages that for you. You have ETFs and mutual funds and index funds. Someone manages that for you. My personal favorite out of like a mutual fund and an ETF, for example, is an ETF, an exchange traded fund. They usually have higher returns, lower fees, and a lot easier to liquidate. Liquidate is a term for sell, so make cash. It's really fast to turn your shares into the cash when you want to sell, right? Now, last thing I want to address is risk tolerance. So obviously you need to have a certain amount of risk tolerance for all these vehicles. The debt instruments have a lower risk, lower reward, all the way up to gambling on options. I don't like the term investment style. I like the term investment goals, because everyone's style doesn't have to necessarily match their personality. It's not like if you are a more cautious person, you're going to take less risk. While that may be true, as you go on, you're going to see that you need to have different strategies and different for your goals. If you, for example, came into a lot of money, or you have a high income job and you're not planning to retire for anytime soon, and it's relatively stable, you're going for the long term, you want to look at kind of that medium to low risk return, right? Because you want to preserve your capital as much as possible. If you have millions and millions of dollars, you're going to look at the lowest risk possible because, again, right, $20 million, even if you get 1% return on that a year, it's still great money, right? Rather than risking your 20 million for 7% and losing it all. What was the point of that, right? What was the point of you working so hard or your family working so hard for that? So obviously, if you have that kind of less money, doesn't mean go all out and buy the most risky stuff you can find. It just means take a more kind of veiled approach and look at your goals. If you're looking to buy a house, obviously steadily increase and stuff like that. But if you are, just have like 10% of your portfolio, you need a new desk that's like $3,000 and you only have a few hundred, and you've agreed that that's kind of the higher risk and higher reward. So that's more of a personal preference. I'm kind of somewhere in between that. Okay, so again, this is not advice. Please do your own research, and do remember, guys, to like, comment, and subscribe. It does help the channel. Liking it for the YouTube algorithm, and making sure to comment any questions that you have, and most importantly, what videos you'd like to see. As I can only do that based on your viewership and what you say. Okay, so I hope I did help out, and please leave a comment if you enjoyed it and if you would like me to answer any questions. Okay, great. Thank you, everyone, and have yourselves a wonderful day.